Hey, what's up, Facebook? Adam Merrill, American Southwest Mortgage. I want to touch base with you guys today about what is rate lock. Try to explain all that stuff to y'all. I get asked this all the time. If you don't mind, I've got some stuff written down. I'm going to go over with you guys. So I get asked, what is rate lock? Rate lock is an agreement between yourself and the mortgage company about what your rate is. So it is basically whenever you find a property, you like that property, you get a contract, you send me the contract, I say, okay, rates today are 4.375. Let's lock in your rate. That is going to protect you from rates going up even more. So if you lock in today and right before you close on your home, if rates are 4.75, you don't have to pay that higher rate. You pay the 4.375 that you locked in today. Now, the downside of that is that if the rates go down, then you still pay that higher rate. Now, your lock rate can be between 15 days, 30 days, 60 days from the time that you lock it in to going up to there. Now, what happens if you end up closing after your rate lock? Then you file for an extension. And I'm going to say this word points a few times. What I'm referring to is not your interest rate. And some businesses, they call that points, your points of interest or whatever. I'm talking about points is a percentage of the loan amount. So 1 point is equal to 1% of your original loan amount. And then you break down that into bips, which is basis points. So if I ever say 125 basis points, I'm referring to 0.125% of your loan, or 1/8 of a percent. So whenever it comes to extending it, you can extend for a week or 2 weeks, and you're going to pay either an eighth or a quarter point, which on a $200,000 loan can be $250 to $500 to extend that. Now, what happens if it expires and you don't extend? Then you're stuck with worst case pricing. Worst case pricing is, let's say again, 4.375 today. You go to close and it's raising to 4.75. If it expires and you do not extend your lock, then you're going to be at the mercy of the higher interest rate of the two. The higher of either current market or what you locked in at, which in that case would be 4.75. And that can cost you a lot of money going down the road. Some cases $100 a month, depending on the loan size. So when can you do it? You can lock in your rate as soon as a seller accepts an offer to purchase and you have a purchase contract. Once that's done, you send it to your lender and get that done. Why do you have to wait till then? It's because there's so many factors that go into calculating a rate, like the location, the down payment, the size of the loan. If it's $150,000 or $200,000, you'll get two completely different interest rates because there's a different return for the bank that's lending you the money. And then the other one is going to be also the loan program you're going with. If you're going through an FHA or a USDA or a VA or conventional, the loan pricing is going to be different between all of those programs. The other one is cost. Again, the cost difference is, like I said, off of points. It'll be an eighth, a quarter, a half, 1 point is what it'll charge you. Now, whenever you talk about buying down an interest rate, which is something that's really good, just to kind of get off topic, you can buy your rate down, and a recapture rate is how long it takes you to save in payment the amount that you paid up front. So let's say that you lock in a rate and it ends up costing you a full point to get it there on a $200,000 loan. Well, that's going to cost you $2,000 to buy the rate down. Let's say from 4.375 to 4.25. That's what it cost you. And let's say that it's going to drop your payment $40 a month. Well, 40 into the initial 2,000 is going to be 50 payments. So you're going to have to make 50 payments on that deal. Once you make those, now you've recaptured your initial cost, and you're going to start saving money going forward. So it's a good thing to do, to discuss with your mortgage lender if you plan on being there a long time. This is something you don't plan on being there 2 or 3 years. Locking or buying any rate makes absolutely no sense because you won't recapture the cost. But just so you know, as your lender is not going to generate any additional revenue for that. You're basically just paying those upfront charges up front to get that rate down. Your lender does not benefit off of it all. If they keep trying to push you towards it, it's probably because it's a good idea to, because it saves you money, and they can see that it saves you money, not because they're trying to make more money off of you. So that's a big misconception I hear all the time from people, that we're just trying to make more money. Not the case. The other one is, when does it expire? I already went over that with you. Whenever it expires, you'll be at risk of paying for an extension, which again will be 1/8 or 1/4. So the $250 or $500 you talked about earlier, it can cost you to extend that rate. And if you don't do that again, what's going to happen is you're going to be stuck at worst case scenario of the higher, whatever current pricing is or whatever your rate is. So if that makes sense. Now, guys, I always want to help y'all. I want to educate y'all. If you have any questions, if you have any concerns, just send me a message. something like that, I'll answer directly. If it's a question that I hear all the time and maybe I don't think about talking about it, I'll even bring it up and I'll talk about it live. So again, guys, my name's Adam Merrill. If you have any questions about mortgages, just ask me. Bye.